Ladies and gentlemen, welcome and thank you for joining us in this new series on ebnet.stream called Inside Private Markets. I'm extremely excited to be hosting this series, what I believe is an incredibly important topic for all of us in South Africa as investors, both as individuals and as trustees of retirement funds. South Africa only invests 2 to 3% of retirement fund capital into our private markets. Internationally, that number is in excess of 20%. Why is that so different? In order to deal with many of the problems that we have in South Africa, like unemployment, inequality, etc., education, we have to invest at grassroots level. We need to direct private capital to help grow and develop South Africa for all. That allows us to also generate opportunity to produce good returns for all members of retirement funds into the future, ensuring that they can retire comfortably. It simply makes sense. Yes, it's not without risks. And that's why we are holding this 12-episode podcast in order to help you understand and identify both the good and the bad of private market investing so that you can make smart choices. I'd like to take this opportunity to now thank Old Mutual Alternative Investments, who have sponsored this series so that we can bring it to you for free.
Progress doesn't happen overnight. It's built deliberately, patiently over time. At Old Mutual Alternative Investments, we invest where capital can do more than grow, where it can build. We finance infrastructure that keeps economies moving, energy that powers homes and industry, schools that educate future generations, businesses that create jobs and resilience. Because behind every asset is a human outcome. A light switched on, a classroom filled, a community connected. We manage capital across private markets with one clear belief. Long-term returns and long-term impact are not opposing goals. They are inseparable. This is investing with purpose, with discipline, with conviction, turning Africa's structural challenges into investable opportunities and patient capital into lasting progress. Old Mutual Alternative Investments, building real assets, creating real outcomes.
Ladies and gentlemen, welcome to the second episode in the series Inside Private Markets here on EBNet Stream. I'm delighted to be joined today by Paul Boynton, who I refer to as a stalwart in the industry of private equity, private markets. And we're going to be discussing the history of private markets in South Africa, which is a bit of a strange question because surely private markets have been around forever in terms of our economy. But we really want to dig into the last, call it 25 years, 30 years since apartheid and how private markets has developed in South Africa and started to become a destination of choice for some and an option for others, particularly pension funds. So Paul, welcome. Thank you so much for joining us.
Leon, wonderful to be on the program with you. Thank you.
Great. Now, you started off your career, CA, did an MBA. You started off as, I'm going to call it a traditional portfolio manager, managing life assets. Is that correct?
Yeah, the early part of my career, I did a little bit of investment banking, then I moved into the investment world and at Old Mutual, and I was originally on the listed side, running balanced portfolios, which are equities, traditional balanced portfolios. The sort of peak of my career in that regard, I guess, was running the life assets for Old Mutual at the time, which things have moved on now. But back in the day, there was a single portfolio manager with a small team responsible for the entire life balance sheet. So I ended up running that small team. The time we had $50 billion equivalent under management, and there were a team of 3 or 4 of us. That was quite.
So I can go back to those days. So I started working in 1995, and I remember the the initial surveys that we did of asset managers in South Africa. And I mean, those days I always joke because we could do an investment survey, it fitted onto one page, and we were proud that we could sort of color code the quartiles. Nowadays, it's a very, very different picture. But those days, a lot of the market was dominated by the larger insurers, and you would have your traditional balanced mandates, which is traditionally what pension funds used. And the only exposure that I remember to anything that was non-listed in any sense was sort of under the regulation 2.5% other category. And it tended to be the insurer's own properties that they owned, and maybe a couple of strategic unlisted shares that sat within those portfolios. So that's what I remember as my first introduction to private markets, and that was done away with quite quickly as people started taking on the Coronations and the Alan Greys and so on.
Yeah, that's absolutely correct. And in fact, that's one of the reasons, I guess, that Old Mutual was early into the alternative space, because having sort of such a relatively big balance sheet at the time, even though you only had a modest permissible percentage into other assets, as it were, it did allow for the investment into unlisted and private assets, which Old Mutual did kind of was involved in at the time when I joined them. Not in the traditional sense of running private equity funds, but for instance, they had interest in Total, the French Total. They were a minority shareholder in Total's business in South Africa. They were a shareholder in some manganese mines at the time, unlisted manganese mines. So they were the odd unlisted investments that Old Mutual had made over time. And they had traditionally looked at that on the basis that if they ran it through an investment process and decided that this was, on a relative basis, very good value compared to going into the listed market, then, they would consider going into the unlisted market. So they had a handful of these assets on their hands. And when I first started at Old Mutual, I kind of got involved in that portfolio a little bit as a sort of more junior guy. And one of the issues Old Mutual had was liquidity in those situations. They hadn't, in many of them, they hadn't contracted for liquidity, which is, a standard thing to sort of do in a more modern private equity context and a fund-driven private equity context. So, but some of those kind of issues within the portfolio led to the development of Old Mutual's thinking in, going into the fund market, trying to evolve with the sort of industry globally and doing those kind of things. So it was, I guess, fortuitous in a sense that when I arrived there, they sat with an existing position in some pretty sizable companies, actually. But yeah.
So you got to be one of the most boring people to ever interview, because your whole career was basically mutual. So there's only mutual we could talk about. It's become more interesting subsequent to that. So I'd like to also just get your view on your life now. But you started up Old Mutual Alternative Investments, or whatever it was called at the time. They're the sponsors of this series. That was early on. It was quite a long time back. And what was the thinking at the time? Because pension funds weren't really paying much attention to any form of private market or infrastructure investing.
Yeah. So I, in my role as, when I initially joined Old Mutual, I was involved, as I suggested, in some of the unlisted investments and some of the more esoteric areas of what the life assets were involved with. But so a couple of years later, I took over responsibility for the entire sort of life assets portfolio. As the portfolio manager responsible for the overall assets of the life business, I also had responsibility for these unlisted positions like Total and Asmang and whatever. So I was quite involved. It was a small percentage of the overall portfolio, but it was a much more bigger percentage of my time, just given the complexity involved in some of these things. And I got more and more involved, and it was an area of interest for me. And I did have some background in this, having spent 7 odd years with Investec as an investment banker. So the intricacies of private investment were not new to me, in the sense that I'd sat on the other side advising people doing M&A. And as the space developed and we built our position more in the infrastructure space to begin with, to be honest, rather than private equity, I kind of made the decision to move out of the listed portfolio area and to focus exclusively in the unlisted asset space. And that was, I guess, the genesis of the Old Mutual Alternative Investments business. And it didn't actually happen at that point in time, but it led over the next couple of years to approaching external investors to invest alongside Old Mutual in funds that we then sort of constituted in the infrastructure space, and then into private equity, and then into various other asset strategies.
And who would those investors typically be? Was it also pension funds? Because around about that time, I think it was a lot of talk around socially responsible type investing and so on. That was almost the opening for pension funds in terms of unlisteds and so on, to a degree.
Yeah, so I think, Leon, maybe just to kind of zoom out a little bit here, I think, Old Mutual's development was a part of the overall kind of a development of the industry in South Africa. And I guess maybe if you just take a step back and look at, how did private equity start in South Africa? I think it kind of kicked off really with, LBO's first corp under Andre Roux was an early mover in this space, and Capital Partners, with Anthony Ball leading them, were another early partner in raising capital to back management buyouts. And this is obviously a trend that had started with KKR in the 70s in the US and moved into Europe. And I guess in the mid 80s, the sort of landmark deal maybe was Hudeco, which was a buyout led by Andre Roux, which did incredibly well. And it was accelerated by apartheid, actually. So there was a big disinvestment, particularly by US multinationals during the apartheid era. And so these, quality businesses were becoming available for acquisition in the local market. And often the US multinational or European multinational might allow the management team to look for a buyer. And they would then, be looking for if they wanted to lead the buyout as the management team, they would then try to, source capital. So, that's led to the creation of Ethos and Capital Partners, which ultimately became Brait. And Old Mutual had, as I mentioned, historically, just on balance sheet made investments from time to time. And so this freeing up of business opportunities to invest into, and also, the capital available, kind of led to the industry starting to move along. Subsequent to 1994, there was another factor that came into play, which was BEE financing. So the desire of businesses to attract a BEE partner required a capital financing solution. And once again, private equity type capital was able to step into that role. The banks were prepared to lend so much, but not the risky end of the financing solution. So, private equity stepped into that space. So, and within Old Mutual, we were quite part of the vanguard, in a sense, of trying to drive BEE funding. We saw transformation of the economy as something that was very good for Old Mutual in the long term, for the country certainly. And so we wanted to participate in trying to make that all happen. So we mobilized capital through private equity to get into the BEE funding space. We also, at the same time and coincident, were thinking about infrastructure as a very important part of facilitating growth in the economy. And, we were, trying to get capital into the infrastructure space on the basis that if we improve logistics and power availability, we started actually in the roads space, but it was really all of these areas of capacity within an economy are important to develop in order for economic growth broadly. And if we could put capital to work into those spaces, then as a big investor in the overall economy, many of our businesses that we're invested in would benefit from that. And so it was a self-serving thing, but nevertheless also important from a national perspective. So we were kind of pushing capital into both those spaces. And we, at the same time, this is in the late 90s in respect of the infrastructure space, and in the early 2000s in respect of sort of the private equity buyout strategy, established funds and went to solicit third-party investment into these strategies. And so that was an evolving space. We, interestingly, in the context of the infrastructure space, we went with a open-ended fund. And the complexity of these investment structures are some of the reason why private equity has as an asset class, or unlisted asset class, hasn't grown as rapidly as it might otherwise. But we ended up in the infrastructure space with an open-ended fund, which is an enduring fund. It's not a limited time fund, and new investors come in, and old investors, under certain conditions, are able to exit their investment. Whereas in the private equity space, our sort of evaluation of the opportunity led us to the traditional partnership-driven closed-end structure where you raise a fund, you draw down over 5 years to make investments, and over the next 5 years you realize those investments. And in theory, over 10 years, your investors have invested capital and had it fully returned and are out. So we had two different strategies for having assessed what the market could do, in terms of what investor appetite would be for those two different asset classes. So, and then over time, the other factors that have driven things in the industry, I think, are in the buyout space, which was driven by the disinvestment by US multinationals, then by BEE transactions, and also delistings from the Johannesburg Stock Exchange in the early days. We had regulatory, and often regulatory issues in the business make a big difference. But we had regulation on the JSE, which made it much more difficult to take a company private on the JSE. And that's something, by the way, that I think is still not ideal in the local market, is the difficulty in terms of taking a company private. And so that's kind of got into a little bit of headwinds there, the take private strategy. But if we kind of fast forward now further on, we've seen global developments have been similar as well. But if you look at the number of companies listed on markets like the JSE, certainly, but also in the UK, in the USA, the number of listed companies has been declining over time. And the amount of capital raised in private markets has been increasing globally over time. We're seeing, the advent of many companies getting to, billion-dollar, multi-billion-dollar market caps before looking to list. And we may even this year see the first company coming to market with a market cap in excess of $1 trillion as a private company. It's an extraordinary.
Who are you talking about there?
I'm talking about SpaceX. SpaceX
is. About to say,
yeah. Look, it's with this merger of XAI, it's now a company valued at $1.25 trillion. It's extraordinary.
Yes, I was reading this morning, and actually what it made me think is we too often think of things like private market investing as investing in the smaller opportunity sets out there, but it's not true. Some of the most established, well-run and profitable businesses are ultimately private, and more so that's been becoming the norm over the last couple of years. But I was surprised by when you said it's difficult to take companies private with the JSE rules? I mean, we've had so many delistings over the years and a drop in the number of listed shares. I was surprised to hear that. Do you have a comment on that?
Well, it's more, sorry, so I think that is right. We have seen companies delisting, but the challenge that I'm referring to there is that in order to secure support for a transaction, and obviously if an entity is looking to hostile, not hostile takeover, but to buy out a company on the stock exchange, they've got to persuade sufficient shareholders to accept the offer to go private. And the threshold that's required to achieve that on the JSE is higher than it is in other markets. And that you can understand the arguments for why that might be good, but the negative, the counterpart to that is that the efficiency of the capital markets restructuring things and assets that are not working on the listed market being taken off the listed market is challenged by making it more difficult to execute that kind of transaction. So in the early days of private equity in South Africa, there were many takeout transactions where businesses were leveraged off the Johannesburg Stock Exchange. But it's more difficult to do that now, just from a regulatory point of view in terms of the thresholds that need to be met.
So you mentioned the likes of Ethos, Brates, there were yourselves. If I now look at the list of guys who claim to be GPs or private market investment managers, that list is long. It's almost more extensive than the traditional sort of group, and all the traditional guys are going into PE as well. So there's definitely a sea change that is taking place. I'm actually busy trying to create a portal for EBNet where we want to be able to display who's raising capital, what are the funds that they're raising into, what themes are they trying to support, and so on. But there's obviously been this change that's taken place. How do you perceive that? Is this just a natural maturing, or what's driving this go-to market now?
Yeah, I think it's definitely, the market is growing, the amount of capital. I mean, you did earlier intimate that South Africa has, moved along the path of pension funds and institutional capital allocating to private assets at a slower rate than we've seen in sort of the US or Europe, or in particular even in Australia. And that is true, and maybe we should come back to that. But I do think that it definitely is nevertheless an expanding part of the universe. And so it is a growth space. And what we are seeing is funds that are focusing on particular niches. So, whereas, when we sort of initially started at Old Mutual, we had infrastructure and we had private equity. We then, moved into the impact space and launched funds that were focused on education. And then we launched funds focused on affordable housing. So we're seeing that across the industry, that people are, healthcare is another space where people have launched focused funds. Fintech funds, for instance, have also, so these thematic funds, I think, have the advantage of a management team who are focused in a particular space, and they can go deeper in that space. The counter argument, of course, is that there's less, if you're a broad buyout fund, then there's a huge set of opportunities and you can pick the best out of the whole set of opportunities. But obviously a focused fintech fund has got people who are deeply knowledgeable about what's happening in the fintech space and hopefully able to, potentially find transactions that are not, more broadly available because they're intimately involved with that ecosystem, and also to be more insightful perhaps around what spaces within the fintech area are more likely to kind of prosper over a 5-year horizon. So I think these focused funds are a very good thing. The sort of expansion of the industry is good. So I think this is a natural evolution. It's important that it happens. The big difficulty, I guess, in the asset management industry broadly is I think there's consolidation is going to happen globally in asset management. So it's a very difficult industry for consolidation to happen because, the asset base gets in the lift at the end of the day.
Mm.
And merging teams and getting people to, is such a difficult process. But never, clearly there are, globally, probably too many folk active in the asset management industry. If you compare that to other similar industries, and I'm not talking about alternative assets in particular here. I think it's possibly even more difficult in the traditional space.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
So I want to come back to what I call debunking some of the myths. And as you were talking, I thought about 10 different things that I wanted to sort of test with you. But before we get to that, you mentioned other countries. We sit at 2 to 3%. Across pension funds invested in private markets. A lot of that is the bigger pension funds or state-owned type entities and so on. That is changing. The awareness is there. Some consultants have been fairly proactive, others less so. But the rest of the world, 20 to 30%. I mean, I'm involved in a business in Europe where it's mainstream. It's as important as any other part of their investment strategy and so on. So is this just a case of a bit of lag and catching up, given that regulations have called it modernized as well over time? And do you expect South Africa to move to that sort of level, in which case the industry should boom?
Yeah. So Leon, I think there's a lot to unpack in this particular issue here. But by the way, I do think that South Africa will over time converge on where the rest of the world is. And I think a lot of it is regulatory in a sense. So obviously the expansion under Reg 28 of permissible investments in South Africa has been hugely beneficial, and the industry needs to take advantage of that. I think another difficulty in South Africa, or maybe it's not a difficulty, but another factor in South Africa, is that the industry is largely moved into defined contribution. And defined contribution funds find it more difficult to allocate capital to illiquid assets because they are less confident around the retention of assets within the fund. And so I think solutions in that space, I think how trustees consider that needs to evolve. And I think we also need to develop solutions in that space to mitigate in that regard. But certainly, if you look at a country like Australia, and for many years we had a partnership with Macquarie in the infrastructure space, and they were sort of they were the vanguard of developing infrastructure as an asset class in Australia, and Australia was the place where infrastructure as an asset class was developed globally, and that happened because the states in Australia were faced with budgetary, so not the national government, but Victoria government, New South Wales government were faced with fiscal challenges, and they looked to solve that problem by turning to assets that they owned and bringing in the private sector. So they said, look, let's sell off the estate in a way to try and manage our fiscal situation. So they started selling down electricity generation assets, airports, roads. These things all came to market in Australia, and because it was each state was doing their own thing, it became somewhat competitive between the states. So if you are Victoria State or if you are New South Wales and you're trying to mobilize capital, you want to get your airport into the market earlier because, you want to soak up the capital that's available to invest, that's interested in an airport investment before, Sydney gets their airport out there, and then no one wants to kind of buy into your airport type of thing. So it was a virtuous circle in a way. At the same time, Australia introduced compulsory superannuation. So there was a lot of money coming into the institutional investment market in Australia at the same time that there was an opportunity to invest in these assets, which are perfectly matched for long-term investment. Infrastructure assets are long-term assets. They're sort of predictable cash flows over time. So it was a virtuous circle, and I think that's what we need to think about here in South Africa as a country. That if we can create these virtuous circles, and I think we have done that with the renewable energy space, where we were able to mobilize capital against an asset class, and government was very creative in the way that they positioned those opportunities into the market. They created an investment framework that was consistent. The documentation, the legal documentation around investing into the renewable energy industry was established and consistent. They came with a predictable pipeline of opportunity for people to invest into. So businesses were prepared to sort of commit resources to evaluating the opportunity, because even if they bid on this round and they're unsuccessful and they prepare a project, they knew there was a continuing kind of opportunity set in a way. So I think, if you look at the job of capital markets is to efficiently allocate capital within the economy. If we zoom out to that level, it's important that these regulatory constraints within the institutional investment framework are removed, and that the opportunity to mobilize capital into areas that really are productive for the economy and drive the best outcomes for the economy. It's very important to get that right. So I think, we're doing quite a lot of stuff right in South Africa, but there's stuff that still needs to be improved, I think, to kind of optimize.
So I agree, the operational framework of it all, there needs to be some innovation taking place. I've always said to myself, you get blended finance to try to encourage people to get on board. Can't they solve the liquidity problem in some way by supporting from a liquidity perspective? So there's things like that that need to be thought about to try to make it easier for private capital to get involved. But I think the other thing that I'm seeing a big shift in, and it's a good and a bad thing, is that there's a greater social awareness that is starting to take place. So it's driving the impact investing discussion, but right now that's been driven more from a supply than a demand perspective, and the two need to come together, because it's very easy to market something that hits you in the heart. The reality is it's got to ultimately pay off, and I do see that maturing, and pension funds getting behind that, because I always say, your fiduciary responsibility is to ensure your member retires comfortably. But within a country like South Africa, if they're retiring in 30 or 35 years' time, well, helping them retire comfortably, the environment needs to be conducive at the end of the day. So we do need to invest for that eventuality. So I see that starting to move, but there's a road still to travel on that.
Leon, I think that's such an important point. And I think the sort of what I call ecosystem thinking, if you improve the ecosystem as, for within the institutional investment framework, where you're, pensioners who are invested in pension funds, there's a common interest in improving the ecosystem broadly. So, for instance, investing in things like education, which really, you look at how do we improve our outcome over time, things like education, things like infrastructure. There is so important that we, have the best possible outcomes in those spaces. And so I think that targeted investment that you're raising there in terms of driving, national growth outcomes is so important. It really is.
I also think that you talk about education. So to me, if I put it at the top of the list of things that we need to solve in South Africa, and we're not selling it as an investment in education. We're selling it as an investment in a fund that has an IRR expectation of X. And so it sort of takes away from the essence of why you're investing in it. And I don't think we're getting that right in the conversation. And I don't think that the advisors in the market, they taking it away from the importance of that impact,
Yes.
essentially. And I think a lot more thought needs to go into how these things are positioned and why people are buying into it. And then not secondary, because it's as important, are the return aspects and the liquidity aspects. Right now, those are getting put right at the top. Rather start here than solve for the rest, if that makes any sense.
I think that's right. I think that is absolutely right. And I also think the other thing that needs this liquidity issue, I think just needs to be, I think it needs to be graduated. Liquidity is clearly a risk within a fund, but I think you've got to look at what are the levels of illiquidity risk we can afford to take. And obviously you can't take an extreme risk, but there is a modest amount of risk that you can, if you look at any corporate pension fund, the bottom 10% of that pension fund is in any downside scenario is intact. I'm not an actuary, Leon, so I defer to your. But I do think that the liquidity risk needs to be more expansively considered in a sense, because I think there's a real return premium for taking on some limited element of liquidity risk in a fund. And I think that trade of accepting some level of illiquidity in order to obtain a return premium, but also to be invested in some of these things that really do make a difference.
But it's the age-old debate that, I mean, a lot of funds would say to me back in the day, we can't take on any risk. We must put all of our money in cash because we can't take on any capital risk whatsoever. Okay, I get that. Yes, but we need a 5% real return. Okay, well, which one is the greatest risk for you at the end of the day? Because if you're going to sit in cash, I can guarantee you're not going to get there. So it's the same for pension funds. We tend to look at these risks in sort of absolute terms. So yes, liquidity is a risk, but so is not investing in the future development of South Africa. All right.
Yes.
Which one do you want to weigh up in which way? So yes, some funds, if they can't handle the liquidity, why? Because they've got few members. Or if it's an umbrella fund with few participating employers, and if one pulls out, suddenly they've got a major problem. There they've got to balance those risks. But you're 100% right. A retirement fund is a long-term funding vehicle. Right. And part of that is making sure not just that the individual has sufficient capital, but that bread doesn't cost 1,000 times what it does today, kind of thing, in the future. So I'm convinced we're going to get our heads around that. But yesterday I hosted a webinar and I asked the question in a poll: what are the two most concerning things for you around private market investing? And it came back liquidity as number one, and the second one came back, unsurprisingly, fees. Now I do think that the private market space has been wrapped up in this alternatives sort of label, and hedge funds have stained that a little bit with the fees and the carries and so on that. And yes, you can say that the absolute level of fees in private markets is high relative to traditional management, but you touched on it earlier. The level of involvement you have in the investment, the level of due diligence, the ongoing involvement. I just want you to touch on that, because it's a lot more than to simply due diligencing a company, investing in it, and then disinvesting at some point.
Look, I think it's critical. The hands-on nature of what's going on here is so important. In any private equity transaction, there will be certainly the way Old Mutual used to look at it, most of the private equity players, there would be at least one, maybe two individuals from the team sitting on the board of that business. There would be, others in the team involved in that transaction, although they might not, there are a limited number of board seats available, perhaps. But certainly you are regularly meeting with the management team. You are framing strategy with them. You are establishing deliverables. You're very involved in evaluating, making sure that you have the right people on the bus. Is the management team fit for purpose? You are partnering with a management team to deliver an outcome, and the management team are generally incentivized on that outcome, which is creating an exit for the fund that is valuable, that drives an outcome. So the private equity team on fees, I mean, maybe just to digress briefly, but I think the thesis from a private equity fund manager's point of view is, we need to be paid a fee which covers the cost of running the shop. And as you said, it is more expensive because you've got more resources in terms of people and whatever dedicated against each transaction. But there shouldn't be a material profit available for the private equity fund manager out of the annual fee. The carry upside is what should drive meaningful outcomes for the fund manager. And so if that is the case, then the fund manager is going to pay the lights and water, but nothing more out of the fee. But if the fund does well, then they earn a percentage of the outcome. The management team generally are also driven off of, the management team of the company that you've invested in. Once the private equity fund exits, then there is a big profit participation available for the senior guys in the management team. And generally, once again, bonuses and things like that from year to year are quite modest. And that is the intent. You don't want a management team in the business, doing well until, you as the fund and the beneficiaries of the fund investors have actually, participated in a good outcome. So I think this alignment point is so important, and it really underpins outcomes that actually, people within this value chain do well if the fund investor does well, but they don't do well if the fund investor does not do well. That is the thesis behind the construct. And if that all works well, then I think you've got great alignment. And that is one of the advantages, compared to being in the listed market, where that alignment issue is not as profound. I mean, there are many advantages to having a company listed, but one of the disadvantages, I think, is that there's this alignment issue is often not as complete and direct as it is in the sort of a proper private equity driven model.
So for the layman, carry is a new, nice term, probably not so new from your perspective, but new from an investor's perspective, around another way of wording a performance fee. Essentially, it's a performance fee, but it's one in the private market space where the investor should be achieving a certain level of return net of fees. And if that does happen, there's outperformance of that at the point of maturity, then the management of that company and the asset manager will then earn fees to not just cover the cost, but to be rewarded as profit in terms of that particular deal. Is that a good way of explaining it?
So, Leon, if you look at a traditional private equity fund construct, the fund will be raised. So in other words, you go out and you get investors to commit capital. Let's say they raise a billion rand. That billion rand will be invested, and the promise is that it will be put into companies and returned to the investors within 10 to 12 years. So it's a 10 to 12 year investment. Over that time period, the fund manager will charge a management fee, and they talk about 2 and 20. These numbers sometimes vary slightly, but it's a 2% per annum management fee. That's high, obviously, compared to the listed market, but it's 2% per annum because of this, intense stewardship role where there's a lot of people involved in driving each investment. So it's 2% per annum that you're paying over that 10-year horizon based on invested capital. So whatever is invested, once a transaction is exited and capital is returned to the investor, then fees are no longer charged on the capital that's been returned. And the 20% is calculated at the end of the fund's life on the basis that investors have received all their money back. So if you invested 100 Rand, you've had your 100 Rand back, then you get a preferred return, which is normally about 10%. So you get your money back, plus you get a 10% return on the money that you invested. And only once you've had that, 100 plus 10, each year, at that point in time, on the residual amount of money that the fund returns, so it's in excess of your 10% return, 20% is paid away to the fund manager, and the investor receives 80%. So it's a residual, and it's only paid out of cash flow. So it's not done on a value on a valuation of the assets. It's only once the investor has received the cash back that that carry calculation is performed.
But I think investors must be clear that they have every right to ask for clarification, to negotiate those terms, but to look at different scenarios, and not accept glib answers around, well, it covers this and it's because of this and so on. They need to see the mathematics behind it, and they should expect after those returns a premium on the return in any private equity or whatever other fund on relative basis, because there is a liquidity risk. There is a default risk. So there should be that ultimately coming through. So that's where the balance again comes into it, and they should demand answers in that regard, and not just always accept what's on the can, to scratch and to due diligence, and that they should be relying and demanding from their consultants that a proper due diligence is ultimately done.
Absolutely correct, Leon. And obviously, if you look at private equity as an asset class, there are varying degrees of risk that funds will be taking on. Infrastructure is a less possibly risky space to be in than, say, fintech. But broadly speaking, if you're investing in unlisted markets, you should be generating a return premium, given that you're taking on this illiquidity risk of 3 to up to 5% on top of what you would be earning out of the listed market. So if the JSE is returning X, then you should be returning X plus 3 to 5% if you're in a sort of broad equity, private equity investment. So I think that's a good way to just think about it from a trustee's point of view. Why are you going into unlisted markets? It's because there's a return premium available. It's because you're able to invest in nation building things which are good, broadly, like education and infrastructure. And it's also, I think, a diversification issue, that putting money into something like fintech or agriculture, or these things are much less investable within the listed space. So if you want to, there's a diversification opportunity, in a sense, to be in these areas, which also adds value. Diversification is the free lunch in investments. So
I always like to have a little tongue in cheek. So in the first episode, I spoke about the terminology that got first used with me by a London-based PE firm who spoke about their dry powder that they had, and I always found that quite funny at the time because it sounded very cowboyish to me in terms of it. But the other tongue in cheek that I always think about is when anybody ever mentioned private equity to me, it was like, run away, run away, they're coming to take our jobs away. Run away, run away, run away. Why do you think that sometimes people feel that there's a private equity player partner coming into a business? You're part of management, and your time, it's Mindar.
Yeah, look, private equity has been through, if you look at the evolution, obviously the industry, I guess, was originated in the US, in the early 1900s. Some of the investment banks were doing private equity deals, similar to how Old Mutual had done things back in the day. But really the industry started, I would say, in a more formal way in the US in the mid to late 50s with an extraordinary guy, a Harvard professor, who started a company called American Research and Development, which was really the first VC fund. It was a listed company ultimately, the first VC fund. It didn't have a completely stellar track record, but nevertheless, it did make one investment which was just off the charts. I think they put less than $100,000 in and took over $300 million out in investing in a computer company. But the rest of the portfolio had somewhat modest returns. But that was the first kind of VC fund, and that fund was copied by guys like Sequoia and Kleiner Perkins. Some of the West Coast, sort of stalwarts, vanguard of the VC industry. And interestingly, the guy who started that fund went on to be a founder of INSEAD University in France. He was a Frenchman. So, INSEAD was founded by Giscard d'Estaing as well, and George Poirot. He was the Harvard professor. But then in the 70s, you had KKR and the buyout, the bootstrap deals in the US, where companies basically used their cash flow to finance the acquisition of their shares, and it was and so the buyout firms did these bootstrap deals, and in that era there were some transactions which were kind of slash and burn, where the business was acquired and then the private equity owner would come in and just cut aggressively and turn assets to account in order to kind of get rid of the leverage and suck the marrow out of the bone type of thing.
Synergies.
Synergies, yeah. So there was some activity like that, and there was one character who was called Al Chainsaw Dunlap back in the day, because that was the modus operandi of how they went about things. But I do think that that can happen in the corporate world as well. It's not only private equity that will go in and be very aggressive about restructuring. But I do think that private equity has been extraordinary. And by the way, the British Venture Capital Association did some research on this back a few years around how much private equity businesses have grown. So it's generally not a slash and burn strategy in the private equity space. It is a growth strategy. It is around trying to invest capital into growth spaces. And a lot of private equity strategies are buy and build. That's a big theme for many private equity managers, that they start with a footprint and then they look to consolidate and add and
reinvest.
And reinvest and geographic expansion and product expansion. Those are big things that so private equity, I would say, is much more around growth than around that sort of downsizing and restructuring and whatever. But regardless of that, I do think that the sort of genius of the capitalist system is that things are restructured. Things that are not working are taken to a new space where they can work. And the US economy has just been absolutely unbelievable in this context. And I know one of the horrifying stats I remember is that after 9/11, the US airline industry laid off 100,000 people, I think, in 3 months. It's just extraordinary, but it's a calamitous outcome. But the upside of that is that businesses are restructuring to the opportunity that they face forward, rather than living in the legacy past where things are not working. And you have to move forward, and you need to move forward to a good outcome for people, and you need to be thoughtful about that. And the just transition conversation within transitioning from coal to renewable energy, for instance, in South Africa, is so important. You've got to be thoughtful about the outcomes for folk, but it doesn't help to remain vested in the past if it's not working. You've got to confront your future. And so this the capital markets facilitating that happening, I think, is so important.
I should know the answer to this, but did Berkshire Hathaway invest in private investments as well, or was it just listed?
Look, their genesis was private. Warren Buffett famously said, he preferred to invest in a private company. But if the company is listed, if the brilliant company is listed, then that's where you make the investment. But all things being equal, and obviously in the early days, it was mostly in the, a lot of it was in some of the unlisted space. So yeah.
Well, just to close off for today, you've obviously now, I don't know if the right way of putting it is, hung up your boots. You told me that you injured yourself. It's a retirement injury, but what was it, falling downstairs or something like that? So my sympathies go out to you. I know how it feels. What else are you involved in? I actually noticed that you're the chair of Core Ed or Core Education, which interests me because I'm busy doing some, or we're doing some webinars to the parents of Core Ed kids, just all on early stage understanding of finance and planning through your life, kids' education, all of those kind of things. So I was just interested in finding out what your role there and how did that come about? Is it something from your investment days or is it more from kids and so on?
Yeah, so well, thanks, Leon. And look, sorry that I couldn't be in the studio, but I'm on crutches, so it was, the journey from Cape Town to the studio was intimidating for someone on crutches. But yeah, look, Core Education is a business that Old Mutual's education fund has invested in, led by Dr. Benny Fourie. Benny Fourie started the Royal Schools Group many years ago, and the Royal Schools are part of Core Education. So Core Education is invested in a number of different schools, about 10 different schools. I think 4 or 5 of them were the original Royal Schools. And, Benny Fourie is an inspirational character. He really wants to, he comes from a family of educators and he wants to make a difference in education. And he's very committed. And, he's committed to making affordable education available. So it's private. It is a private school. It's privately funded. There is a profit motive in a sense, but it's hugely about trying to drive great outcomes. And it's about building schools and building academic outcomes for kids that kind of really deliver. And so that's the mission there. And so I guess it's like a mini Curo or Advotech, but it is growing well. And this year, for instance, last year, for instance, at Acudeo Kirkney, which is one of the schools, Acudeo is another group as part of Core Education. A youngster there, Kamohelo, was the top private school matriculant last year. So that's a wonderful accolade. A youngster he's actually coming down to UCT to study actuarial science. So, the actuaries should be happy about that. But an extraordinary story, his individual story, but also that the school, which is an impoverished area, has produced just a wonderful kid who's doing amazing things with his life and has taken the opportunity of access to quality education and really put time and effort into his outcome and just achieved an extraordinary result. So it is about trying to improve educational outcomes. Obviously we have 12.5 million kids in school in South Africa, so improving educational outcomes is but it's like the starfish story that for the starfish who gets put back in the water, it's a profound outcome. So to the extent that we can build, this is Core Education, we can build more and more schools that are focused on quality outcomes in sort of underprivileged areas at an affordable price point. I mean, unfortunately, it still does cost to go to these schools because putting this all together is not costless, but it's a much more modest fee outcome than traditional sort of private schools. So that is the objective, and that is what Benny and his management team are driving at Core Education. It's a wonderful story.
I must say, I find them to be very innovative in their thinking around what their proposition is back to the families that I suppose they serve. And also I follow them on LinkedIn, and I find they always capture me because you've got so many things on your feeds that you just scroll, and every time I'm back to just see what's going on there for whatever reason. It just shows you that there's things that are happening there that are worth paying attention to.
Yeah, absolutely.
So anything else that you're up to?
Look, I sit on a number of investment committees still, so looking at things in the infrastructure space, some of the education fund I mentioned. CISA has a supplier development, enterprise development fund. I sit on an investment committee for them. I'm also the chair of M&G Investments in South Africa, which I'm sure you will know well, Leon, but they used to be the Prudential, and they've got a sort of controlling shareholder is the M&G PLC group in the UK, which went through a big restructuring with, the M&G UK separated from the Prudential in Asia. I mean, they were all part of the same group. M&G and Prudential were two different historic brand names in the UK that were consolidated way back. But in terms of that demerger, the Prudential in Asia kept the Prudential brand name in their listed name, and the M&G Prudential in the UK as a listed company became M&G. So that's why Prudential in South Africa, which was a well-known brand name, has changed to M&G Southern Africa because of the demerger in the UK. But they're still owned by M&G PLC, or 50-something% owned by M&G PLC.
I remember, it's a funny story, Graham Mason, when Prudential first came in, he came to see the head of the actuarial division that I'd started working in, and he was sent away. And I was too young at the time to even think about it, but he was sent away because he didn't have a 3-year track record. So we sent away one of the world's largest asset managers because they didn't have a local 3-year track record. Something doesn't sound right about that to me. But anyway, Paul, it's been an absolute pleasure. Thank you so much for sharing your experiences and your wisdom with our audience. This is all about creating comfort with what the private markets industry is all about, what that opportunity is. And it's about, little bits of extra understanding that will lead us to, I think, a fairer and healthier environment for all private investors in South Africa. So thank you for contributing to that. We wish you all the very best in anything that you are involved in, and please do stay in touch.
Leon, thanks very much. It's been a real pleasure to have chatted through the history with you today. So thanks very much.
Yeah, all the best, and all the best with the foot.
Yeah, thank you. Cheers. Bye.
Cheers.
But what about returns? Does the performance of private company investments justify the investment for many investors?
Yeah, we would say yes. We looked at data for particularly VC and growth equity returns, and they've actually outperformed other asset classes for the last 25 years, particularly public equity. And so this isn't just kind of a blip. This takes into account a longer period of time, and we think it's a secular trend that's not really going away. I'd say one of the arguments for why that's happened is because you've got innovative companies that are growing a lot while they're private and staying private longer. And so the returns are often generated while they're private companies rather than they're public. And that's a big kind of secular change from, say, the late 90s, early 2000s, when we think of kind of the dot-com bubble and burst, which was that companies actually grew materially when they were public rather than private. And we've seen things kind of flip on its head. And this is exactly kind of what investors have been looking for on our side. We get feedback all the time about wanting to invest in these companies. And I think it's one of the kind of linchpins of our success.